Have you ever wondered how you could use real estate to lower your taxes? If so, then this video is for you. Today, I'm going to explain how losses from real estate can help offset your W-2 or 1099 income. The main focus of this video is to give you a simple step-by-step guide on how to purchase a rental property and then use it to generate a loss for tax purposes, helping to reduce your overall tax bill. If you're new here, I'm Dr. Jeff Anzalone, real estate investor, periodontist, not a tax advisor. So the information that we're going to give in this video plus part two should not be taken as financial or tax advice. This is simply educational information only. Look, my goal is to help you understand the complex world of taxes and ensure that you're maximizing all the benefits that are available to you. If you haven't already downloaded the free passive income guide, go ahead and do so with the link below the video. Now, why should you consider real estate as an investment strategy? Because it allows you to grow wealth while at the same time reducing your tax bill. Think about it. This is a combination that few other investments can actually offer you. And in this video, I'm going to demystify this process of using real estate losses to benefit your tax situation. We're going to get into the ins and the outs of the short-term rental rules, the real estate professional tax status rules, and above all, how to maximize your tax savings for 2023 to save the most money legally possible. So our first topic is going to make sure that you understand the rules regarding and governing real estate. Now, the rules I want you to understand pertain to something called the passive activity loss rules. Now, these were established back in 1987. Now, I'm going to be upfront with you and show you my age. In 1987, I was nothing more than a little punk eighth grader, okay? And I can assure you, at the junior high that I was at, we were not learning anything about the passive activity loss rules. Back then, Ronald Reagan was our president, and he actually put into place something called the Tax Reform Act. This act reduced the marginal tax rates, but it also closed many tax loopholes. One of the key tax regulations it introduced was the passive activity loss rules. Now, you might be wondering, what are passive activity losses? Let me simplify it for you. Whether you invest in real estate, which is categorized as a passive business, these rules actually come into play. Now, what do I mean by passive? Essentially, once you've bought an investment property, you don't have to basically put in any additional work to earn from it. You get a tenant to rent from you, and they're the ones that are paying down the principal based on the agreement that you've set as a landlord. This arrangement lets you earn passive income from your tenant. Now, what the passive activity loss rules did was limit the extent of passive losses that can be actually generated from real estate and then used to offset income, active income, let's say from a W-2 job or 1099 job, or even from stocks or cryptocurrency. Now, the aim of these rules was to prevent everyday salaried workers like probably you or your friends or both or your family. So these rules was to prevent just everyday good old salaried workers from investing in real estate solely to evade taxes. Whether you agree that's fair or not doesn't really matter, because that was what was put into law back in 1987. Now, in the year before that, in 1986, the IRS was looking through a lot of tax returns of high income salaried employees. Back then, if you were earning $250,000 from a salaried job, you were considered a high income earner. Many of these high income earners, think about it, were attorneys, physicians, dentists, people like that. Many of those people were working more than the standard, quote, 40 hours a week. They were working 60, 80 hours a week or more. But interestingly, many of these people back then were investing in real estate, which, think about it, that was a great move back then. And they were using the losses incurred from the real estate to offset their W-2 income. So even as their earnings were increasing year after year, as may be happening for you, their tax liabilities weren't keeping up at the same pace. Now, the IRS, the government, they took notice of this trend, what was occurring, and it actually led them to create these passive activity loss rules. Now, what these rules do is they prevent W-2 or 1099 taxpayers from simply going out, buying real estate, using the losses from the real estate to offset their active income. This rule puts an end to this practice. Instead, the passive activity loss rules, they actually distinguish between what exactly is a passive investment and what exactly is an active investment. It basically segregates out the two. So from 1997 to the present day, these rules disallow the use of passive losses to offset active income. So your W-2 and 1099 income are all considered active income. This change, as you can imagine, upset many taxpayers, and a significant number felt the impact as they saw their taxes really go up from 1987 all the way to 1994. Now, you may be saying, well, what happened in 1994? Well, in that year, the IRS actually revisited the passive activity loss rules. They made some adjustments. They specifically defined a group of actually 11 types of real property trade or businesses that could convert passive losses into non-passive losses, which then could be used to offset active income. And these 11 types of businesses were real estate property development, real estate construction, real estate reconstruction, real estate acquisitions, real estate conversion, rental real estate, which is choosing to rent out the property, rental operations, rental management, leasing, or brokering. Now, if your business falls into one of these 11 categories, as defined by the IRS, you can use the time that you spend in these real property trades or businesses to convert your real estate losses into active ones. Now, one thing that we haven't touched on yet is the difference between a passive activity loss and a non-passive loss. When you invest in real estate, one advantage that you get is the ability to claim depreciation. Now, I've talked about depreciation on multiple videos on this channel. Essentially, depreciation allows you to count for the wear and tear of the property, of your rental property over time. The IRS assumes that your property is going to undergo wear and tear over a period of about 27 and a half years for residential property. Therefore, because of this, they allow you to recover the cost of your building wearing out over this time period in equal installments over the 27.5 years. Whenever you adjust depreciation, you can generate what's called a paper loss on the tax return. Let me explain. If you get into rental real estate, you collect rental income, right? Your tenant pays you income. This is taxable. But 90% of the time, most real estate investors, they don't end up paying any taxes on rental income that they receive. Why is that? Well, that is because thanks to the additional expenses that are associated with running that property. These expenses of owning a rental property include maintenance costs, management fees. More than likely, you have a loan, so you have to pay interest on your loan, repair costs, etc. But guess what? The largest expense that you're going to get each year is depreciation. Again, this is the wear and the tear of your property over this 27 and a half year period. And it provides a significant yearly deduction that's going to help you offset the income you receive from your tenants. Think about this. As a periodontist, I have patients coming in, and the only way that we generate income is from patients. We do work on patients. We do treatment on them. My wife's the hygienist. She does treatment on them. We get income from the patients. Okay. Think about if there was something within the dental medical ownership property realm that I could get a deduction every year that I could legally offset the income from my patients. That would be unbelievable, right? So when you think of it in those terms, it's like, why wouldn't you invest in real estate? They're giving you something that as the money comes in to offset it. The government is giving this to us. It's like a gift. Okay. So, and I'm trying to teach you about this, to educate you about this. So the annual expenses that you incur from running the property combined with the depreciation, basically your rental investment business is pretty much always going to operate at a loss. And this scenario of a loss is something that, guess what? All the wealthy people aim for. They want their business, their rental property business, to operate at a loss. Why do they do that? Because they hate to pay taxes and they don't want to pay taxes on their rental income. More importantly, they want to use their rental losses to offset their active income. And to achieve this, they make a lot of money, they pay a lot of taxes. So they got to get a substantial amount of this guy right here, depreciation, which is why real estate investing is often considered a game, kind of like a chess match. My youngest son, he loves to play chess. He's very intellectual. I don't think like that. But that's what the wealthy want to do. They want to play this game like a chess match. Now, when I talk to new members of my investment group, the Passive Investor Circle members, most of them, they simply want to just replace their active income with passive income from real estate. Okay. They say, okay, well, I'm making $200,000 a year actively treating patients. I want to make $200,000 a year in passive income from real estate, and then I'm good, because they think that's the main goal of real estate investing to begin with. Just I can just replace my active income, I'm good. But if you only focus on the cash flow and you overlook the role of depreciation and the potential tax loss benefits it can bring, then you might really not be that motivated to get into real estate in the first place. Now, you may believe that the potential returns don't really justify the effort involved. Getting into real estate involves taking out a loan. It's got an interest rate, which, as you know, right now, debt's pretty darn expensive. And when you invest in real estate, your property, let's say you buy a single family home, it only may provide cash flow of like 100, 200 bucks a month after you've paid all the expenses. Think about it, 100, 200 bucks extra a month may not seem really worth to deal with the tenants and the complexities of a real estate for just a small monthly amount. But here's where that tax game comes into play. The experienced investors, they understand that their cash flow isn't solely based on tenants paying down the mortgage. They see their cash flow in the form of tax saving. So imagine instead of just $200 a month, you're actually getting $1,000 a month when you factor in depreciation. $200 to $2,000, that changes the whole conversation, right? Now you may be wondering, how can depreciation yield an additional $1,800 a month in cash flow? Well, it's all about the taxes that you're saving, remember, on your active income. And to take advantage of this, you need to educate yourself. You need to understand how to create a property loss and how to use those losses effectively. Now, to generate a loss on your tax returns from real estate, you can do it one of two ways. Now, a loss can be generated as a passive loss. Okay. So we have a passive loss. Okay. A loss can be generated as a passive loss, which can only, remember, it can only offset passive income. So a lot of times people, they get into real estate syndications and they get depreciation and they think that can offset my active income. But remember, can't, because of the passive activity loss rules. Passive income from things like real estate syndications, capital gains income, dividend paying stocks, all of that type of losses can only offset passive income. Okay. And again, people, they want to use real estate losses to offset their active or their non-passive income, right? So to use these losses to offset your active income, one of the most popular ways to do it is by obtaining rep status or real estate professional status. This term often causes confusion for many people, particularly those working full time at a W-2 job. It refers to a specific qualification in the real estate space that allows you to use these losses from your real estate to offset your active income. It's actually a designation given by the IRS to taxpayers who meet certain requirements related to their participation in their rental activities. Now, if you qualify for rep status, then the rental real estate activities in which you materially participate are non-passive, then now you can use any losses generated by the depreciation, so any of the losses by those activities to offset, guess what, your non-passive income. Now, here's a few key rules to remember, mainly two rules to remember regarding real estate professional tax status. The government requires you to spend at least 750 hours a year involved in real estate activity. This applies regardless of whether your property is located next door or out of state. Also, you must spend more than half of your working time, half of your total working hours involved in real estate activities compared to any other job or profession that you have. Now, think about it. That requirement can be challenging to meet for those already working a full-time job outside of real estate. And it's because of that rule that the vast majority of W-2 taxpayers, they're not going to qualify for rep status. Now, this predicament is a byproduct of those good old passive activity loss rules that we talked about. So remember, when President Reagan implemented them, the underlying understanding was that if individuals spend more time investing money in real estate and then utilizing those losses to offset their active income, they're eventually going to retire as W-2 taxpayers and contribute less in taxes over time. So government doesn't like to get paid less, right? So these rules were put into place as a government measure to maintain tax revenues. And again, this presents a significant challenge for many W-2 taxpayers that want to get into real estate in the first place. Now, if you're really looking for ways to offset your W-2 income, another strategy is to consider investing in a short-term rental business. And this is especially true if you cannot qualify as a real estate professional. So when you invest in short-term rentals like Airbnbs, depending on your involvement, it can be considered what's called an active business. And this classification could enable you to sidestep some of the limitations imposed by the passive activity loss rule. According to that Tax Reform Act that Reagan passed in '87, specifically Section 469, if you're running a short-term rental business, Airbnb, VRBO, things like that, with customers that are coming into your property who stay at your property on an average of 7 days or less, and you're materially participating in this short-term rental business, you could potentially qualify to use the losses that you get from this short-term rental to, guess what, offset your active income, your W-2 1099 income. So in this situation, your short-term rental operation is now seen as an active business rather than a passive one. Now, this strategy allows you to leverage your involvement in the short-term rental operation to create deductions to offset other income, like from a medical practice, dental practice, etc., thereby lowering your overall tax liability. Now, when it comes to running a short-term rental business to offset your active income, it's not just as simple as just purchasing like a beach house in Destin and then just putting it on Airbnb. You've got to meet certain criteria. Okay, there's certain requirements that the IRS gives you, and you have to put in the time and effort to manage the property. Now, understanding this concept, remember we talked about the materially participating. It's very important to determine whether you qualify or not. This actually comes from the IRS tax laws. Generally means regular, continuous, or substantial involvement in business operations. And it's one of the key requirements for your real estate activities to be considered non-passive, which again allows you to use any of the losses to offset income, right? As the name suggests, material participation means you're actively and significantly involved in an activity that you're trying to qualify for. The IRS actually created 7 different tests for material participation. But guess what? You only have to pass one test to say that you've materially participated. Too bad this wasn't the case when we were in high school, right? Here's the good news. One of the most straightforward tests involves spending 100 hours in your real property trader business and more than anyone else. So you're the one doing the most amount of work. Okay. So let me clarify what this means. So when you decide to dedicate time to your real estate operation, your 100 hours or more, that refers to the time spent on personal services directly related to the property. This could include managing the property, negotiating loans, maintaining the property, traveling to the property, communicating with guests, coordinating cleaning staff, etc. All of these tasks count towards material participation. But again, check with your accountant on this. Don't take any of this as tax advice. And the rule then, any more than you're spending more time than anybody else means that you, as the owner, must be the one putting in the most time working on this specific property or business. It's about maintaining control and significant involvement in the business. Now, after acquiring a short-term rental property, you can accumulate additional hours by managing your guests. Now, one of the main tax advantages of running a short-term rental business is the ability to leverage a cost segregation study. This allows for the depreciation that we talked about earlier to be accelerated. So now we can create an even bigger paper loss. When we create a paper loss, on average, we typically see around 20 to 30% of the building's value accelerated to a 1 year write-off. Think about it, that could be a substantial benefit. So for instance, if you bought a property, let's say for $200,000, and the value of the building structure, the building is the building structure is the only amount eligible for depreciation, not the land, but the building. So let's say that the value of the building structure was $100,000. You could potentially take a tax write-off of 20 to 30%, or $20,000 to $30,000 in a single year, thus helping to offset your active income. Now, the beauty of this approach is that while it's a paper loss for tax purposes, it doesn't mean that you're losing money in the real world. You're still collecting rent and hopefully seeing your property, guess what? Continue to go up or appreciate in value. So now that you have a clear understanding of cost segregation studies, paper losses, the material participation rules, short-term rentals, real estate professional status, and the passive activity loss rules, the next question is, well, how do you actually use a real estate loss correctly? Now, typically the cost segregation studies, they're only conducted, okay, and depreciation is only accelerated when we know that we can offset active forms of income. So this strategy is used to avoid the trap of accumulating passive losses. Now, when losses are categorized as passive, they can't be easily unlocked or recategorized at a later date. So for example, let's say you decide to switch your property out of the blue to a short-term rental, or if you just decide to spend more time in real estate than your W-2 job to meet the real estate professional requirements, okay? So it's best to get into real estate investing early and then strategically position yourself to unlock these losses and eventually offset your active income. So now that we've covered rep status, short-term rental rules, and material participation, let's now discuss how to find the best real estate deal. Now, when looking for a great real estate investment, particularly from a tax perspective, you've got to pay attention to two key factors. The first one is the value of the building, and the second one is the value of the land. You might be wondering, well, Jeff, where can I find this information? Guess what? Everything's pretty much online. Websites like Redfin, Zillow, and Trulia. Go on one of these sites, type in the address that you're looking for. Typically at the bottom of the page, it's going to show you the property tax history report. It's going to show you the land value too, okay? As it's the amount of money that has to be allocated to the land structure of the entire property. And then there's the addition. And this is what basically you and I know as the actual building structure. So you got the land value, remember, and the property value. Remember that the value of the building is important because, remember, that's what you can depreciate, and that land cannot be depreciated. So if you're looking at a property where a high proportion of the value is tied up in land, guess what? Your tax benefits from depreciation are going to be much less. It may not even make sense, like a state like California, right? The property itself, the building itself may not be much, but the land could be astronomical. On the other hand, if the building makes up a substantial portion of the property's value, like states like Texas, Florida, Alabama, Georgia, you'll be able to claim actually a higher amount of depreciation, thus potentially save you more on taxes. Remember, it's super important to educate yourself about what we've discussed today, because if you do decide on going into real estate, remember, it's not all about the cash flow. It's not just about getting that principal paid down as quickly as possible. It's also about those tax benefits, which come in the form of depreciation. I want to thank you for sticking around. This is the end of part one of this video. Now in part two of the video, we're going to go into further detail about depreciation and then depreciation recapture, because when you sell everything, there's going to be something called depreciation recapture tax. Then we're going to talk about how we can avoid paying these taxes to set yourself up for long-term investing. I'll see you in part two.